I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, Mr. Pujari.
Thank you. Good afternoon, everyone, and thank you for joining us on Max Healthcare's Q1FY22 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
Welcome and good afternoon to all. I hope you and your families are keeping safe and everyone's vaccinated. It gives me great pleasure to welcome you to the first quarter earnings call for Max Healthcare for the financial year 2022. Allow me to give you the key highlights of this quarter before opening it up for questions and answers. Starting with the COVID update, we continue to be at the forefront in the fight against COVID through our network hospitals in 6 states. We have already treated over 33,000 COVID patients at our hospitals, in addition to 4,000 patients at their homes and through extended COVID facilities. We have conducted around 6.5 lakh RT-PCR tests and about 14 lakh vaccinations so far. Compared to the first wave, the second wave saw a swift increase in admissions, leading to high occupancies during the first 2 months of the quarter. The peak of COVID occupancies in the second wave was twice that of the first wave. However, the hospitals were better prepared this time and could thus serve the sudden surge very well. Starting May 1, we commenced vaccinations for 18 plus and were amongst the first private healthcare players in the country to offer both on-site and off-site vaccinations. We touched a high of approximately 50,000 vaccinations a day, the pace of which has declined significantly post mid-June, and currently the run rate is about 5,000 to 6,000 vaccines a day. Furthermore, we continue to invest in the clinical talent and upgradation of infrastructure and technology in the hospitals. At the same time, there is immense focus on clinical excellence, and I'm glad to note that our doctors published 65 national and international publications during quarter one. We are also conducting multiple studies and trials both on COVID and non-COVID side. Most significantly, we continue to serve patients from the economically weaker sections of the society. In the past quarter alone, we have treated more than 21,000 patients in IPDs and OPDs, free of charge. Now moving to the financials, we are pleased with the results for the quarter. This is the third consecutive quarter where we have recorded the highest ever revenue, EBITDA and operating margins. Gross revenue for the quarter stood at 1,385 crores, a growth of 124% year on year, and 19% over Q4 FY21. We achieved an EBITDA of 360 crores for the quarter, a growth of 37% quarter on quarter. Our revenues include 136 crores from vaccinations and related antibody tests. Higher COVID occupancy during the quarter led to reduction in ARPOB to 51,500 in quarter one, compared to 56,000 in quarter four on a like-to-like basis without vaccination and associated revenues. The drop is further driven by lower OPD footfalls and associated revenues. The revenues from international medical tourism continue to be below par and declined by 18% over the fourth quarter FY21 due to imposition of air travel related restrictions, which now seem to be opening up. The operating EBITDA margin was 27.2% for the quarter, up 309 basis points compared to the last quarter. Even without vaccination profitability, our operational EBITDA was 25.5% for the quarter. Margin expansion was driven by overall occupancy improvement in direct cost ratios and COVID-19 vaccination and related tests. You would recall that in the last 2 years, we significantly augmented our clinical programs with hiring of teams in key specialties and also executed a structural permanent cost-saving program, which has helped us achieve our quarterly financial performance. Resultantly, net debt as at end of June 30th, 2021 stood at 459 crores and net debt to EBITDA ratio thus remains less than 0.5. There were build-up of inventories of COVID-19, particularly the vaccines and other supplies, and we expect to release this cash within the second quarter of the current year. Now, Max Labs, the non-captive pathology business vertical, revenues grew 2.4 times on a year-on-year basis and stood at about 36 crores. Regular non-COVID business growth year-on-year and quarter-on-quarter stood at 189% and 25% respectively. During the quarter, Max Lab has added 60 new collection centers, taking the count of active partner network to 480. Further, Max Lab is offering its services across 14 cities now. Now coming to Max at Home, it also reported an improved performance with a gross revenue of about 27.1 crores, representing a growth of 150% year-on-year and 17% over the previous quarter. There's a strong team of 600 frontline workers and support staff which served 49,000 patients during this quarter, including 1,100 COVID patients at their homes. Towards the end of the Q1 FY22, the significant reduction of COVID occupancies and significant reduction of vaccination level has been largely substituted by swift restoration of non-COVID business and higher ARPOB. This also allows us to focus on brownfield expansions, growth of Max Lab footprint, enhanced clinical programs, increase our digital outreach and actively evaluate M&A opportunities now. On closing, I would like to put in perspective our journey of last 2 years since the Radiant Max transaction. The combined EBITDA of Max and Radiant for the financial year 2019, what we inherited, was 348 crores, which has now been surpassed by the rupees 360 crore EBITDA achieved in the first quarter of FY22 alone. We are confident of a strong sustained performance in future as well. On this note, I wish to open it up to questions and answers. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Thomas Priju from Acme Capital. Please go ahead.
Thank you. Congrats to the management team on a very good performance. And you indicated that even if you exclude the vaccination, the overall hospital business did a margin of close to 25.5%. So going forward, can we look at 25.5% as a sustainable EBITDA margin with the scope to expand it further as international travel picks up? Thank you.
Thank you. I think 24-25% is something that we have demonstrated now, in both a COVID quarter as well as a non-COVID quarter. We certainly believe that these are sustainable margins, and going forward, depending on opening up travel restrictions, etc., it should have a positive impact on these.
Thank you. And what are your initial thoughts on the way Max at Home and the lab business is shaping up? Do you see both these businesses as hugely scalable businesses over the next 5 years?
Absolutely. So we've seen a 250% year-on-year growth on the Max Lab. It's been aided, of course, by COVID business, but even if you look at the non-COVID business, it's grown by about 170-180%. On the Max Home side, again, it's grown by 150% year-on-year over last year, and on a quarter-to-quarter on a sequential basis as well. Just the sheer number of people, and really Max at Home, I think, has come of age simply because the home care industry itself has come of age, and Max has been at the forefront of this business for the last 4 years, and it's just perhaps the right time now, and we should going forward see both these business an opportunity to explode, in fact.
Thanks and congrats and all the best for the future.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Prakash from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on good set of numbers. 2 questions. One is, we already at about 80% occupancy levels. So, is there a room for debottlenecking and have some capacity in the existing ones? And the second one is, what's the update on the the brownfield expansion that we were planning on both the Saket as well as the Nanavati? And if I may add one more, is there any expansion plans or inorganic expansion plans you might have?
Okay, so I think with respect to occupancy, you would have seen in the presentation as well. A couple of months in the last quarter, we were operating at 87% and 85% occupancy levels, respectively. Now, this is largely on account of high occupancies of this nature on account of the COVID business, because it was high surge business that we suddenly had. However, pre-COVID, we were at about a 70-73% occupancy levels. June, we came down, occupancy level came down to about 69%, almost close to 70%, 69.9%. And in July, we are tracking at about 72-73%. This essentially does not include any COVID patients. We hardly have about 5 or 7 COVID patients in the network at present. So what you've seen is that the increase in COVID occupancy, there's also an attendant reduction in ARPOB. Reduction in the occupancy now is seeing improvement in ARPOB, of course, and like I said, and restoration of non-COVID business at 70-73% levels, and hopefully higher going forward. And like I said, this increase in ARPOB as well as of the non-COVID business and the resultant profitability should largely make up for the vaccination revenues that we had in the last quarter, as well as the high COVID occupancy. This is with respect to the occupancy levels. Now coming to the brownfield expansion, we are looking to commence Nanavati in the current quarter, towards the end of the current quarter. We are hopeful of commencing Saket, our Delhi brownfield, by the subsequent quarter. And with respect to, we also looking at adding about 100 beds in Shalimar Bagh, and that again in the next 3 to 4 months we should commence. And Mohali, we are adding about 190 beds, and that should also commence in the next 2 to 3 months. I think other than this, as you can see, we are at very low net debt levels, and going forward within the next couple of quarters, we should have paid out our entire debt, essentially. So, and still leaves us with substantial free cash flows, even after taking into account our brownfield projects, and we are looking to focus on M&A going forward.
Okay, thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Financial Service. Please go ahead.
Yeah, thank you for taking my question, and many congratulations for a good set of numbers. So just to extending the expansion plan, what you had given. So when these, whether it's Shalimar Bagh, Mohali, Saket, and Nanavati, these are all when going to be in the operational bed capacity?
So Shalimar Bagh and Mohali, we are looking at end of 2023. The expansion at Nanavati should be end of 2024. And again, when I say expansion, the first phase of that expansion, Delhi again should be end of 2024, the first phase of expansion.
Okay, fine. And one more clarification, sir, because in the presentation you had mentioned that 42% of your operating beds were allocated towards a COVID in the last quarter. How much that number currently?
Like I said, 42% of the beds were allocated to COVID, and those 48% of the beds had about a 75% occupancy. That number has come down to about 5 or 6 patients. So literally, I think maybe 1% of the beds.
To the non-COVID side of this bed.
Absolutely. And that's how you're seeing as we speak, our occupancy levels are about 73%.
Okay. So it's overall 73% occupancy, right?
Absolutely. And so this is almost entirely non-COVID other than 6 patients.
Okay. And one more thing, like 136 crore of COVID-related vaccination and test-related revenue you had given. Apart from that, that's a patient-related. How much is on a COVID revenue, like a patient admitted for a treatment?
There's about 321 crores in the previous quarter, which was COVID. Other than the vaccination and antibody-related testing, there were 321 crores of COVID-related out of the 1385.
Okay. And one on the mix, because this time we had seen the pulmonology contribution has increased significantly. So is it because of a COVID surge, or how much is going to sustain?
No, that's right. It's that kind of peaks in internal medicine and pulmonology happened due to COVID, as you would know that you have huge respiratory issues and a lot of people in ICUs, etc. The pulmonology is something which sort of peaks up. This is obviously not a sustainable number when you look at a non-COVID environment.
Okay.
But having said that, you have other specialties like orthopedics and so on and so forth, which come down to absolutely not. So, it works both ways.
Correct. Yeah. Oncology as it reduced, that will go back to the normal.
Orthopedics. Oncology sort of continues, sustains through COVID, but orthopedics is something which pretty much comes down to very, very small numbers. And, pulmonology will go down in a non-COVID period, and there'll be other specialties like orthopedics, etc., which will go up.
Thank you, sir.
Thank you very much. Participants, you may press star and 1 to ask a question. The next question is from the line of Bansi Desai from HDFC Securities Limited. Please go ahead.
Hi, thank you for taking my question. So I just had one on Nanavati. So we were at mid-single-digit margins pre-COVID, at this hospital. So what additional measures are we taking here to improve this, and how will our margin trajectory look like over the next 2-3 years?
So I think, in terms of overall costs and so on and so forth, first of all, I think we need to look at it from a ROC sort of a perspective, right? The total money is employed in Nanavati about 193 crores. And even at current margins, it is a ROCE for about 16%. So it's not, whilst on an overall level at the enterprise, we are tracking at a 28% ROCE. So, it's not necessarily, although it's not operating at levels we want it to, but, on a ROCE basis, still not on a bad footing today. Having said that, it has a personnel cost of about 36% compared to 23-24% across our network. And this we were looking to fix through VRS. We are looking to roll out this VRS in the current quarter and have it implemented by the next quarter latest. So that is what is on the anvil at present. That should hopefully rectify these numbers, our operating numbers, by a substantive amount. But VRS is something which happens in 2 or 3 rounds. This is the first round, so this is the first step towards it to sort of improve our margins. Having said that, expansion is the other route for defraying large personnel costs. Because once we have more beds, you can defray it over a larger amount of workforce, more amount of beds, and that should bring down your cost. But we are not intending to wait up till 2024. We intend to do it through the VRS now.
All right. Thanks a lot.
Thank you, Vansi.
Thank you. The next question is from the line of Ayush Kansari from Allegro. Please go ahead.
My question has already been answered. I don't have any questions. Thank you.
Thank you. The next question is from the line of Harith Ahmed from Spark Capital Advisors. Please go ahead.
Hi. Good afternoon. Thanks for the opportunity. Can you comment on the profitability profile of Max at home business? You shared the revenue from the business, but is the business profitable currently?
Yeah, it is profitable currently. I think we are operating at, what is the margin? So we are operating at about a 12 to 13% margin, and it is being geared up for growth. So we have a higher, obviously, fixed cost with respect to the business to attend to the prospective growth. So at 12 to 13% margin.
All right. And my second one is on some of your digital initiatives. What's the kind of investments we are making on that front, and how do you view the competition that's emerging from some of these app-based players, especially on the OPD consultation side and the diagnostic side of our businesses?
So I think let me state it. So I think first of all, we mentioned that number there this time in the presentation that we have roughly 7 to 8% of revenues coming through digital channel. When I say digital channel, that basically means that we have these websites, we have the digital assets where through we get the revenues from. We have a lead management team. We get around 16 to 17,000 leads every month from the website. So we manage those deals. There's a team and a call center where we call these people up, etc. So that revenue is roughly 107 crores, right? So it's not that. So we have a sizable, I would say, revenue coming from the digital assets and the digital I would say, what they do in the market. Now we obviously trying to integrate these data into a lake and trying to see if we can put some AIs, etc., and be able to build onto this. Right, so that work is on. We are in a, I would say, very advanced stage of giving the LOI to one of the vendors for working on this. It's going to be a 1.5 year project, as I see. It'll be a spend of 20-25 rupees. So that being committed, it's not a 25 crores spend in 1.5 years, but it's going to be a commitment of 25 crores of spend. So I think we kind of selected the vendor, and that's been worked upon. So that's the state, but otherwise we do have a very active team on the digital revenue side.
Okay.
Yeah.
Thanks for that.
And overall, we have video consults, etc. You have the numbers already in the pension. 55,000 video consults.
Okay.
Yeah.
Got it. Thank you very much.
Thank you. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Thanks for taking my question. Sir, just a couple of questions. So first one is on the cost of VRS. Since you're, looking to roll the first phase out for Nanavati in the current quarter, what kind of cost should we build for VRS? That's my first question.
So again, it largely depends on the number of people who take it up. We are estimating about 45 crores of VRS.
And overall, for the entire, all the 3 rounds combined, I presume you would look to roll all these 3 during the current fiscal?
All 3 what? Rounds.
All 3 rounds of VRS.
So it may not be 3 rounds. So you do a first round, you see what the offtake of that is, and then if it is, you can increase the size of the VRS depending on what sort of feedback you get at present. And if it goes well, then you perhaps do a second round within the year. But firstly, it has to be necessary. So you strategize a VRS as you go along because it's a voluntary retirement. We don't know how many people will take it up. We believe a substantial number should be able to, 200 plus should be able to take it up in round 1. And depending on that, we'll come up with the round 2 as well. We'll have to play it by ear.
Got it. Okay. And the second question is on international patients. Are these now starting to trend towards normalization, or are we still far off? By when do you expect things to kind of normalize based upon the feedback that you're receiving from patients who are willing to travel?
No, so I think we are still very, very far off from pre-COVID times, etc. And the sole reason for it is restrictive air travel. As the air travel opens up, we'll see these patients come in. But it's not COVID; it's the restriction of air travel which is sort of creating this problem. we are seeing an uptick, of course, sequential uptick since COVID went down, but we are not, still a reduction from where we left off.
Yeah, so we are at 30% of the normal, right? And the nearest that we come is 70% of the normal in the month of April, and then it suddenly went down.
Sure. Okay. And just one last follow-up question on VRS again. This 45 crore cost. So if we remove it from next quarter results, would we start seeing the margin benefit right away? How should one build that out?
Absolutely. You'll start seeing margin benefits right away.
And if you could just quantify that for us, sir.
No, you'll see margin benefits right away. Let's assume we implement this, we have implemented as per plan in the current quarter. Okay, by next quarter you'll start seeing the results.
Okay.
Yeah, it'll be tough to put a percentage to improvement. We can't say that margin will improve by such specific percentage because we don't know.
I just wanted to understand, sir, if we are spending 45 crores, does that reflect into 45 crores annual cost saving, or how should one look at that? That's the question.
No. You spend 45 crores, you won't get a 45 crore annual cost saving. You should get significantly lower than the 45 crore number.
Okay. Okay. Got it. Thank you.
Thank you very much. Participants, you may press star and 1 to ask a question. The next question is from the line of Senthil Kumar from Joindre Capital. Please go ahead.
Hi. Thanks for the opportunity. Hello.
Yes, hi.
My question is, as on 31st March 2021, company has rupees 2,454 crores of goodwill and rupees 2,333 crores of intangible assets. Will it be amortized over a period?
Yeah, so goodwill is not amortized, but the contracts are amortized over the period of the contract. But then you are looking at the consolidated financials of MHAL, right?
Yeah, you are right.
Yeah, but what happens is that when we report the results, we take these. So there are service contracts that we have with partner healthcare facilities. So in the consolidated balance sheet, those contracts come on the balance sheet, right? You value them and they are on the balance sheet. But when we report these numbers, to the street, we take the PHF numbers also in, and to that extent, that value comes down. Okay. Right? That those contracts vanish. So there is no amortization charge come in the P&L for those contracts later on. You understood or not?
Okay.
So in the MHL standalone, in the MHL consolidated, we also have these 3 partner health facilities, right? Which is the Satyaf Hospital, Devi Devi, Max Patpadanj, and Max Mart. Right? And we have the long-term contracts with these hospitals for providing medical services. So these contracts get valued and they get reflected on the balance sheet because you have to do a purchase price allocation, and that number comes onto the balance sheet, and then those contracts get amortized in the consolidated results. Right? But when we present the result to the street, the presentation that we send to investor presentation, in that number you will find that there is in the amortization line there is an adjustment that we do, right? -7. That number is basically that charge in the investor presentations is taken out because we are putting the PHF numbers in.
Okay.
Yeah. So I'm saying if you see the standalone, the consolidated or standalone balance sheet, that number is very different number from the number that we're talking in the investor pension.
Okay. I got it. Okay, great. And my second question is, what kind of average revenue per operating bed we can expect from the next 2 to 3 days?
Next 2 to
3 years.
Well, can't give you a guidance on that, but
any trend on that?
You have the history to it. You have the numbers, from FY19 onwards in terms of whatever ARPA has been. So I think we do expect the similar level of growth.
Okay.
Yeah, it'll be anywhere 9 to 12% is what you'll see in the previous years.
Okay. Okay. Thank you. Thank you.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Praveen Chai from Edelweiss Financial. Please go ahead.
Yeah, thank you for a follow-up. How is the vaccination rate or the momentum run rate going on for you?
About 5,000 to 6,000 vaccines a day.
Okay. Thank you, sir.
Thank you. The next question is from the line of Prashant from Anvid Corporate Research. Please go ahead.
Good afternoon, sir. Thanks for the opportunity. I just wanted to ask, what is the routine in your presentation? You had said the routine capital expenditure was accelerated in Q1FY22 with an outlay of 48 crores.
That's right.
So can you elaborate on that? And secondly, what should be the annual routine capital expenditure for the company in this year?
We have about 120 crores of annual maintenance capex that we do every year.
Okay.
Okay, so out of that 120 crores, okay, we accelerated and in the first quarter itself, we've done 48 crores. Okay, so we just picked up a lot more equipment and fast forwarded what we are doing. In any case, we were intending to do it through the year.
Okay, so the balance total will be 120 only. It won't exceed that actually.
Oh, no. Yeah. Yeah, about yeah.
Yeah, and secondly, you have an enabling provision for infusion of funds. Hello.
Up to 150 crores in your Nanavati complex.
That's right.
So for what purpose that will be used? It will be for expansion of beds only or for any other purpose?
So both VRS and expansion of beds.
Oh, VRS and expansion. Okay.
And the brownfield, right?
So that VRS will be around 45 crores and the balance will be for expansion of beds?
Yeah, so basically we don't get loan for the expansions, and there's some equity we have to infuse in that entity, Nanavati Hospital. So this will be like a subordinated loan or equity into that company, into that entity.
Yeah, but essentially it's for the end use is expansion. So besides the 45 crores, there may be some payment of gratuity, etc., which already balance sheet liability. So that will all be taken care of from 150 crores.
Okay, so as per this thing, approximately 100 crores will be the equity for the expansion, and the balance will be on the loan part of it.
Yeah, so don't use the word equity there. It's actually going to be a loan into the trust for the expansion, but the loan will be subordinated to the other bankers.
Okay. And what should be the approximate total cost of your expansion?
About 436 crores project.
436 crores. And
That's phase one, yeah.
And sir, the relevant regulatory approvals have been obtained by has already been obtained, or did be obtained in the due course of time, sir, for the expansion?
No, so all approvals are obtained, I think, other than the IOD, which we are hoping within a month or so we should have it in place.
Okay. Thanks a lot. That answers my questions. Thank you.
Thank you very much. Participants, you may press star and one to ask a question. The next question is from the line of Himanshu, an individual investor. Please go ahead.
Hey, thanks for this. I have a few questions. The first one is that 136 crores is your COVID vaccination and antibody test revenue. So for big hospitals, can I say it's like 10 crores per hospital per quarter? And I can assume this would be status quo, and this is good, bad versus competition in Delhi and Bombay.
No, I don't think you can look at it like that because like I said, when we started, we had a monopoly. Now there's price capping and so on and so forth. And offtake itself, like I said, has come down from 50,000 a day to 5,000 a day.
Sure. And on the Nanavati personal cost, I just wanted to be sure, do we have a union at Nanavati? So are they okay with the VRS thing? And just wanted to understand that part.
No, absolutely. So there is a union, and without unions there can't be a VRS. So it has to be something which is accepted by the union, which it is, and therefore we are looking to roll it out.
Okay. And typically, I've seen in, let's say, old trust hospitals, there is an unlimited insurance for employees. Is that the same similar case for you guys also, or do we have a cap in terms of, let's say, 5 lakh, 6 lakh for employees and family?
Yeah, you know, medical insurance?
Yeah, medical insurance.
Yeah, so we have free treatment for employees rather than insurance.
And there is no cap, right? For that free treatment.
No, there is no cap. There is no cap. Yeah.
And employees and family members, everyone, right? The immediate family members.
That's right.
Okay. Sure.
I mean, if you do insurance, it works out to the same thing essentially.
Correct. Obviously. No, makes sense. Sure. And can I get the EBITDA margins for Nanavati currently? Sorry, maybe I missed it if you have given it earlier, given that we are spending so much amount.
Mentioned it, but it's around 10%.
10%, sure.
In Q1, yeah.
Sure. And two more questions. So one was this, typically in this industry, the consultant's profit share is a key lever, right, in terms of getting the best consultants and obviously controlling the cost. So what is our process for Delhi and Bombay hospitals in terms of getting the best consultants, and if you can share the profit share average? I don't want hospital-wise.
We don't have a profit share, but we have about 15% of our total cost is for revenue-generating consultants. We believe it's perhaps the best in class.
15%, right?
That's right.
So is it like a fixed pay, or is it like basis the amount of revenue you generate for the hospital, number of operations you do?
Not on, it's the procedures they do. There's a fixed amount that they're paid on procedures they do, and there's an underlying minimum guarantee in most cases that we provide. But 99% of our doctors exceed the minimum guarantee, so that's become theoretical. It's a fixed amount they get per procedure, so it's not a profit share. So it's not as if you can charge more or as a percentage of the total bill they get anything or anything like that.
Understood. So let's say if I am a doctor and if I do 100 procedures, then I will say whatever is the fixed amount, I will get that, right? It's simple.
That's right. So if you're at the beginning of the year, you have a charge per procedure. So let's say if you charge 50,000 rupees per procedure and you do 10 procedures, you make 5 lakh rupees.
Perfect. Sure. And does it vary across consultants, or is it similar for similar kind of procedures?
No, I mean, it varies. A senior consultant will make more, a junior one will not make the same.
Sure. Yeah, sorry. That makes sense. And sure. And and how do we make sure that we attract the best consultants to our hospital? Is there a process? How do we go about it?
Well, it's a combination of factors. The best means what? Best can mean commercially the best. Best can be from a research and development standpoint. Best can be from somebody who writes because white papers and so on. Somebody else who's mentoring a particular department rather than earning. So everybody's not held to the same yardstick. All our hospitals are academic hospitals. We are teaching hospitals. There's a huge amount of research and development. Like I mentioned, in the last quarter alone, we've done 65 international papers. It's a combination of factors, to be very honest. Some may be commercially better, but others may have better skill sets and so on and so forth. So all of these things are assimilated, and you pretty much you can't have a one size fits all. A team has to be a congruence of each one of these. And I think in some manner we're probably doing it well because we are ahead of anybody else by a mile as far as EBITDA per bed is concerned. So commercially, obviously, overall we're doing this thing. We are the first choice of hospital for all the leading consultants in regions that we operate in, particularly in Delhi NCR. I think we're getting the combination right.
Perfect, sure. The last two questions, sorry. One, the minor one is this COVID allowance for the employees. Is it a big cost for us, or just wanted to understand?
Not really. In the overall scheme of things, not at all. I mean, that's why you've seen the margins sort of move up the way they have.
Correct. Sure. And last one from my side is the sourcing of, let's say, medicine surgical items. So are we looking? So there are a few, B2B companies like Exameds, Medical Bazaar of the country. So are we looking that part, or do we have some better options?
No. So we do engage with all of them, but I think we do the best. We also import something from China. For example, we have the shortage of gloves, so we have to import some from China. So I think we take all the steps to ensure that our cost is managed or optimized.
Sure, thanks. That's all from my side.
Thank you.
Participants, you may press star and 1 to ask a question. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Good afternoon, sir. Congrats for a good set of numbers. What is your sense on Nanavati's margin trajectory over the next 2-3 years? Do you see it bridging the gap with the company average?
No, absolutely. So I think, like I mentioned, every other parameter is best in class other than your margins. But look, overall ROC levels are acceptable, the 16%.
And you said that on margin also front, you see that next 2-3 years it should narrow the gap.
Oh, absolutely.
Sure. Secondly, some sense on the international traveler. What is your sense? Will we start to see a pickup from Q3?
Sorry?
International tourism?
No, I mean, it depends on your international restrictions, and I think, if there isn't a COVID third wave, you should have it back by the end of the year, or even before that. But if there's a third wave, then, all bets are off. But who knows what's going to happen, right, from a third wave standpoint? Because it's really dependent on travel restrictions. We see them opening up right now, and hopefully this trend continues and medical tourism is back, because there's a lot of pent-up demand, I can tell you that.
Sure. And this reduction that you see in ARPOB bed is mainly a function of the higher number of COVID patients that we treated this basically because of the mix?
So COVID patients are on capped pricing, right? So there's a pricing cap on COVID patients that reduces the ARPOB.
And so which means from Q2 we should again see recovery sequentially.
So we're already seeing that. But like I said, COVID is characterized by high occupancy, low ARPOB. Non-COVID is characterized by relatively lower occupancy but higher ARPOBs. Okay, but the non-COVID margins are significantly better than COVID, so you sort of overcompensate for it. But having said that, there have also been vaccination revenues, which you probably won't see the same sort of numbers going forward.
And so on this
recovery right now will largely offset your reduction in vaccinations as well as non-COVID occupancy.
Sure. And on these vaccinations, with the government putting a cap, my sense is that your margins would have come down quite a bit.
That is true, but more than margins, I think it's a double hit, right? It's not only the margin, but the offtake also. You're doing 50,000 vaccinations a day, now you're doing 6,000, so it's a big reduction in numbers as well.
Okay. Thank you.
Thank you very much. Next question is from the line of Jigar Shroff from Financial Research. Please go ahead.
Yeah, thank you for taking my question, sir. I just want to know how many beds are we adding at Nanavati and Saket, the brownfield expansion that you indicated?
So there's 359 beds being added in Nanavati in the phase 1. And there'll be a 650 bed shell that we made in Saket, but 350 will be operational.
So phase 1 Nanavati, we will be adding 359.
Yeah. And plus
existing is 298, so the Maharashtra that is indicated?
320.
Acha, the existing, so we are almost doubling capacity at Nanavati.
That's right, and that is phase 1. In phase 2, we will be adding another 250 beds over here.
And Saket, sir, if you could please repeat?
Saket, we have the ability to add 1,200 beds. Okay, we have plans approved for that. For 1,200. We are going to be building a shell of 650 beds. In phase 1, we will start off and fit out 350 beds. So it automatically becomes easier for us to do the second phase as soon as the occupancy ramps up over here.
So N24 that you indicated, 350 beds would be operational in Saket.
That's right, 700 between the two.
Okay, thank you so much.
350 in Bombay, 350 in Delhi, that's 700 beds. Plus by end of 23, we have about 190 beds in Mohali, and we have about 100 beds in Shalimar Bagh. So that's another 290 beds. So that's 1,000 beds between these four.
Okay, thank you so much. All the best.
Thank you.
Thank you very much. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Yeah, thanks. Sir, just a follow-up on the VRS. as trying to understand. So Nanavati is currently at 10% margin, and you were saying that with full VRS, Nanavati margins would be same as overall group. So is it fair to assume that VRS would be an important contributor to this margin expansion, number one? And for that to happen, what kind of overall VRS cost are we talking about? Thank you.
Well, it depends what the offtake is, okay, and depending on the offtake, if there's inadequate offtake of VRS, then the next round will become more expensive and so on and so forth, right? So we'll have to, I'll be in a better position to answer your question after the first round of VRS.
But with the current assumptions.
Having said that, you're right, as far as EBITDA margins are concerned, the single line item is personnel cost.
Right, because I think ARPOB improvements, etc., has happened, right, already.
It's a relative term. It's happened, but there's a lot more mileage over there that we can do.
Right.
There's a significantly higher amount of ARPOB. And you see in our clusters, we operated much higher ARPOBs, etc., and we believe we can significantly improve upon that.
Okay. So, sir, just from our understanding perspective, how many people are there, how many employees are there in Nanavati presently, and post VRS, what do you plan to bring it down to?
So, Abhishek, basically, if you see the bed to employee ratio, that ratio would be roughly around 8 in Nanavati as compared to 5.5 to 6 in other hospitals, right? So that gives you a number of the employees that we think are of the next leverage in a way. And so obviously this VRS will not solve for all of it, but this will solve for, as Abhay mentioned, around 200.
So it's not only numbers, also cost of employees. Because, for example, the 200 sweepers over there were paid 40,000 rupees plus, and resident doctors paid a similar amount. So it's about also replacing them with lower cost. This thing is not only about redundancies, but also cost per employee. But yes, that's the gap we are looking at. We are looking at, personnel cost, addressing the personnel cost and reducing that gap.
Fair enough, sir. Very helpful. Thanks.
Thank you very much. A reminder to all the participants, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. As there are no further questions, I will now hand the conference over to the management for closing comments.
So thank you all for making the time and being available on this call. Wish you a very pleasant rest of the week and stay safe. Thank you.
Thank you very much. On behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.